All right, so today we're going to talk about the differences, pros and cons of buying assets in your individual name, under a company name, or under a trust structure, and what may or may not be right for you. This is general advice. I'm not an accountant. Make sure you always seek structuring advice from your accountant and financial professionals. This is just an overview conversation of these topics that get brought up all the time. So let's look at where you're starting from. I think one of the most important things to ever do before you embark on any journey is get absolute pure clarity of where it is you want to go. I think this is the number one thing people do not do. Either they don't know how to do it, they don't want to take the time to actually work out what they truly want in life, and so they never actually go down the right path and right strategies for their investments that's going to get them to where they want. Most people, whether it's property or shares, come in, hey, I need to invest. I think you can make money. Let's just do it. Boom, 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 like a machine gun with no real clarity. So let's look at myself and my personal situation for this. So I'm both an employee of my own company and I also own my own company. So I get paid both in wages and also company profits as dividends if I choose to take those dividends. So my goal is actually to never stop because I want to build, and I love the aspect of creation, both in business and also with the assets. So I do have those clear goals and milestones that I want to achieve across that path. One of them is a net income of $100,000 a month from my investments. So to do that, I then go all the way out to that figure, $100,000 a month, and I work backwards. Well, how many assets do I need to own after all costs, if we're talking real estate, to get to that figure? Once I know that figure, and let's just pretend that's 50 assets, do I then want to own them debt-free? Am I happy to have debt on them? And how does that play with the numbers? So once I know that, I can then also work out, well, hold on, what does my income need to be to get to that goal? And how much debt, realistically, do I need to be able to carry? How much reserves do I need to have to hit that target? So let's just pretend, for easy numbers' sake, I need to be able to carry $20 million worth of debt to hit that level. So if we're talking those high figure numbers, it's what does my income need to be, both as a salary and also as retained company profits, to be able to show a high enough income to eventually service $20 million worth of debt. That's almost step number one. Once you understand that, we can then look at, well, what are the different tax structures I may be able to buy those assets in? So should they be bought in my personal name? Should they be bought under a trust and under a company? And this is going to be different for everybody, but I would dare say if you had a real conversation with your accountants and you said, this is what I want to achieve, the best way often to do that is actually buy those assets under a trust structure, because under a trust structure, certain lenders will enable you to borrow a lot more debt because they exclude each trust from the next purchase if that next purchase is in a different trust or entity. This is exactly what I've done. So I don't own any assets in my personal name. They're owned either directly under a company or I've purchased them under a trust. So then let's pretend I was to open up a new asset holding vehicle today, Bennett Family Trust, let's just call it, and it wanted to go borrow a further $2 million. Well, the debt I have in these other facilities, I do not actually need to put those down when I'm going for this application because my assets actually wash their face and service them themselves. So that then enables me to turn around and borrow a lot more money than I would if they were all in my individual name, because I need to actually disclose the debt that I currently have on that application. So I think that's one of the first things we need to get to is, how many assets do you need to own? How much debt do you think you need to be able to hold and service to have that amount of assets before those assets do their thing over time? And how much income do you need to make? So I think that's point number one. It can be quite overwhelming if you've never done this before, but sitting down with a professional, we can sort of map that out over a 10 to 20 year period and then work with your accountant to actually help you achieve that outcome. So that's really stage number one, is get absolute clarity of what you want to achieve. And then let's work out backwards what you need to do from an asset lending perspective. And then we'll work with your accountants under what type of structure they should be done. So let's look at trusts and buying in trusts in a little bit more depth. Again, not financial advice, but if you purchase an asset inside of a trust, what are the general pros and what are the general cons? Well, if you're a salaried employee, a con may be any loss on that particular asset, you can't write it off, say negative gearing against your personal income because you personally do not hold that asset. So the cash flow shortage, if there is one, will physically be actually worn from your pocket without a negative gearing or tax adjustment. However, the longer you hold that asset inside of the trust, that asset then becomes profitable on a weekly, monthly, yearly basis. You can then take those retained losses and write it off at some point in time. Also, if you were to sell that asset, held inside of a trust, you get the 50% capital gains exemption. Now, depending on who the beneficiaries are of that trust, let's pretend you make a $100,000 profit, you can distribute that to multiple people, again, reducing your tax liability inside of that entity, which you'd end up paying less tax than if you held it in your individual name. Another pro for buying in a trust, especially if you're planning to scale out a portfolio, is that your borrowing capacity increases with the more assets you buy rather than having them in the individual name. So if they're held in an individual name, all of your liabilities, including your personal residence and your investments, go towards your serviceability. If they're in a trust, typically the lender will exclude those debts in the trust as you go to buy the next asset. When borrowing, however, and this is important that a lot of people don't talk about, what you don't get to do is actually you don't get to add negative gearing back in the lender's serviceability calculator. So if you're going for your first investment property and you're a salaried employee and you buy in a trust, your initial borrowing capacity is actually less because most lenders will not add back the negative gearing benefits because there technically aren't any onto your personal income, which means initially you borrow less. So it's the long-term aspects of borrowing that actually are most enhanced when buying inside of a trust or a company for that as well. So let's then talk about buying assets inside of a company. This is much less common. However, I can see and talking with many accountants, it's becoming more and more common to even skip a trust and buy them directly into a company. That's maybe for many reasons, depending on how you're planning your family out and who can eventually have control over those assets. So what are the cons? The first con that I always see if you're buying inside of a company is that there's no capital gains exemption. So if you sell an asset inside of a company and you make a net $100,000 profit, you have to pay company tax rates. So in that example, $30,000 on that 100 grand, so 30% tax. That can be perceived as a con. Then some of the pros are, however, and this is more so if you're running your own business, is that you can distribute money from your company to say a bucket company or an asset holding company at 30 cents on the dollar, whereas you had to go to your name first, you may be paying up to 47% tax. There's a possibility to save 17% tax, which I see as like a gain if you're distributing company profits into either a holding company that then buys your assets. So you can actually save up deposits and or pay down those assets at 30 cents on the dollar instead of that money transferring through your name first and having to pay 47 cents. So one of the reasons I've actually bought 4 of my assets inside of a company is for that exact reason. I was able to extract company profits at 30 cents on the dollar to build up those deposits and buy those assets. I can then also transfer profits if I desire to help pay off the principal at 30 cents on the dollar, not at 47. For me and for my personal strategy, which is to build a large portfolio of eventually debt-free real estate, that helps me achieve my long-term goals. So it doesn't mean it's right for you, but it's just an understanding of, hey, maybe this is a solution to be able to get to where you want to be able to go. So being able to pay off your properties, if that's your goal, at a faster rate if you own a company, this is where the advantage of your assets being held in a company can benefit you because you're transferring company profits at 30 cents on the dollar to eliminate that debt. So depending on your long-term goals, can also depend on, is that the right structure for you? Let's talk about buying them in your individual name. Now, again, everything comes back to what you want to achieve long-term, what your current situation is today, and where you foresee it also going of how you're going to make your money in the long term as well. So I would dare say, if let's say you're the quote unquote average family who want to buy 1 or 2 investment properties, again, speak to your accountant, but generally speaking, the best way to go is just to buy them in your personal names. The reason for this is because you get the tax write-off of the negative gearing against your personal income. That for most people has a huge benefit from a cash flow situation. They're also not trying to accumulate, 5, 10, 15, 20 properties. They want to get 1 or 2 properties to add to what they're doing inside of their super fund. So the easiest way to do that is to simply buy them in their individual names, write off any losses against their personal income, and let those assets grow over time, using the ultimate leverage of time to do its thing to achieve their goals. Again, it comes down individually. Can you achieve what you want to achieve? Do it in your own name. Have you sought the right advice based on how this is going to look over the next 10 to 20 years from your accountant, and setting that up? The last place to look to buy properties is actually a fantastic one, is inside your super fund. So super funds, once set up as a self-managed super fund, can buy those real estate assets for you. Now, we know the super laws are changing and you're going to get taxed extra once you've got $3 million. So if you're a couple, that's $6 million worth of assets that you can actually hold before you get that unrealized gain taxed on side of your assets. So why is it sometimes a huge benefit to potentially look to buy your asset inside of super fund? I think a huge one, especially for most families who might be struggling for the holding costs of their normal assets, is because they don't actually see the effect on their individual cash flow on a month-to-month basis. And the reason for this is, let's say you to buy a $600,000 asset inside of your super, you actually sell down some shares or whatever other assets you have and use a real hard deposit. So you're only actually borrowing 80% of that investment property, whereas outside, most people use leverage from other assets to borrow 100% finance. So you're borrowing less money relative to the asset that you're buying. And then if there is any shortfall, it comes from your mandatory super contribution anyway. So because you're already making those super contributions, it's that money that goes towards helping pay off the debts and cover any shortfall, which is then is not felt and impacted outside of that structure. So your everyday living, everyday costs doesn't actually personally get affected. So you can continue to live a normal life without the worry of, I need to find $500 a month to hold this investment property, which I know is going to be great for me long term, but in the short term, maybe that's something you can't manage to do. So that's why I think holding assets inside of a super fund can be really, really beneficial to help build out your investment portfolio to hit whatever it is your long-term goal is for retirement. And it's just another way to hold and secure those assets. There's obviously also huge tax benefits holding those assets inside of your super fund come retirement as well. And this is something you really want to sit down with those professionals, being your accountant and financial planner, to map out the long-term strategy to see what entity is right for you. Should you mix your assets across all 3 of those structures or 4 of those structures to get to your long-term goals? I hope that helps. These are things that we map out for our clients. So if you want to sit down for a strategy session, if you have an accountant, we'll bring your accountant into those so we can actually work out that long-term roadmap for yourself to know what type of assets and what type of structure you should actually buy them in, and look at the pros and cons of each.